Today might have been a relatively flat market for some, but a not so flat market for others. Those of us who are following the inflation trend and playing the inflation trade benefited especially strong today, despite a relatively flat market. And some may go to my last video where I heavily criticized people for using February data, people in the Biden administration, and they may say, oh, well, everyone else is using year-on-year data, and that's not accurate because it's a base effect problem. We had serious, downsides last year, and they're right to use the February data. And to that point, I say, I don't care. Last year was crazy. We shouldn't even bring up this base effects notion into consideration. We should go month over month, look at charts of prices of goods, kind of ignore the dip and the comeback. It doesn't matter. You can look at that. You can consider those base effects. You can do all that. I'm going to stay away from that. I'm going to look at the month on month, the increases in corn, lumber, etc. You've seen it all. Copper, that stuff. And it seems pretty clear to me that there is some inflation. And I believe the strongest and most important and most potent effect for inflation, which is going to make it structural, has yet to happen. And that is upward wage pressure. And I believe this is something that's going to happen. We've had a lot of stimulus, a lot of unemployment benefits, and, there's expansion of the economy. It seems people want to spend and they want to get out there, and there's going to be a crunch. There's going to be a crunch. And when there's a crunch, companies have to do what they've been doing, which is offering signing bonuses, increasing wages, and that kind of stuff isn't going to reverse. On top of that, Joe Biden and the Democrats initially said no, $15 minimum wage. He later changed course on that and said, let's go back to it in a State of the Union address when he was last speaking to Congress. I'm not sure if that's a State of the Union. Similar to a State of the Union, I suppose, his address to Congress. Let's bring back that $15 minimum wage, the way he said it, just like that. So we'll see what happens with that. Regardless, wage pressures, huge input costs. If they go up, they increase the price of the final goods. Inflation, to me, seems almost inevitable. We've got additional money circulating. That's going to have to get around. And if it doesn't get through wages, which it will, but if somehow it doesn't, you got this big new spender out here called Uncle Sam, who's going to be taken from the rich who aren't, they spend, but, would otherwise be going to the stock buybacks and dividends and savings accounts and that stuff. They can take from that because that's what they're doing. Capital gains increase, corporate, whatever. Taking from that and plopping it over there to the wage earner, to the hourly earner, to the construction people. So, how do we play this play? We want to take advantage of it. And over here on this channel, this is what we've been doing. We are confident in structural inflation. We might be wrong. It's possible that it's transitory. But, like most people are saying, there's no indication of it being structural. I say there's no indication of it being transitory. I'm not convinced. I'm not convinced at all. We've increased the money supply. We've seen wage pressures. We've seen ridiculous month-on-month gains. And if it's transitory, you would expect companies suppliers to adjust, and they haven't really done so. We're hearing about the chip shortage taking years. It's not transitory if it's years. It's going to be across the board. What, farmers are going to get more land all of a sudden? Maybe. But for now, and for the foreseeable future, it's structural. Structural inflation. So how do we take advantage of it, and what do we want to do, and what do we want to stay away from? Well, as we said, today we were massive winners. We were winning in things like energy. It was fantastic. Well-priced real estate. And there's some real estate that will do particularly well, better than other real estate in this environment. It has nothing to do with the type of real estate. Yes, you want to be considerate to some of that. Multifamily is especially good and secure in this kind of inflationary environment, or any sort of possible recession that happens from it, because that's likely to happen when the Fed increases rates and all of a sudden your savings accounts are worth less. Pretty scary environment. That may or may not happen. We'll see. And that's real estate that is highly levered. For example, if you look at a company like AHT, they have more debt than equity assets on their balance sheet. What gives? The stock was recently at $2.50 a share, right around there. It's kind of been up and down between there and $4. Now it's breaking to $5. Finally, and the dividend used to be around $3 or $4 a quarter, something like that. This company has more debt than assets. But in inflation, what happens? The value of the assets goes up, and the value of the debt, it'll stay the same in nominal terms, but in real terms, it'll go down as the nominal terms of the assets go up. So we want highly levered real estate, in particular, that has good assets. So we're not worried about that makes money. We're not worried about AHT is that kind of company, and you do your homework. But I personally happen to have that in my portfolio. So, that's the kind of company we're looking at in an inflation environment. In addition, energy, commodities overall, anything which is going to correlate with inflation, with the decreased purchasing power of the dollar, going to require more dollars for it. Energy is one of those things. It's got several fundamental tailwinds as well. One of which, India coming back online, Europe coming back online, the notion that the economies of the world aren't even in full force yet the price is at several year highs. Very good thing to see. And there's no indication production is going to come back online. Doesn't look like energy companies are eager to reinvigorate production. Some went under, there was some consolidation recently. But the picture looks good for energy. So we're staying long this trade for a while until it gets rich. Then we'll pull out, assuming there's something else. Gold, I've been very bullish gold, held through the dip, bought options at the low. I'm selling those options now. So I still like gold, want to take some risk off and some particularly risk associated with a deadline, like an option. The reason for that is I expect interest rates to start taking up. As I said, do you think inflation is going to take effect? I'm not saying a hyperinflationary environment is coming and we're all going to switch to Bitcoin. I am open to that possibility, and I think it's certainly a possibility, but we are still far from that. And that I have no indication. Well, no, I don't want to say that because there's signs. Anyways, we still like gold. We expect, possibly it's going to stay flat around here or sell off a little bit. One possible outcome as rates rise. Another possible outcome is inflation gets relatively strong and it continues to rise. Regardless, we're ringing the register, taking the gains on the options, staying long the gold miner stocks, staying long the physical gold. So, that's the deal for today. And until next time, peace out.